The bond market's ripping to the upside. Often in the past, it's been a leading indicator right before big market events. Is this going to be the same this time around? Let's dive in and take a look. All right, let's start off by taking a look at the 10-year yield. And what you can observe here is that we're now trading below 4%. And while we had two little intraday periods of trading below 4% during the Liberation Day crash, this is the first sustained period where we've actually closed below 4%. So this is the lowest yields of the year. The bond, this, when interest rates are declining, it means that bonds are rallying. And so here, if I just put up a chart here on the 10-year note, you can see it's trading at 52-week highs in a very distinct bull phase. This is the case on the 30-year bond working its way to the year highs, but also on short-term bonds such as the 2-year. And this is where I want to focus on. The 2-year bond often has to price in the expectation of Fed rate cuts and acceleration. We can talk about that as well from a SOFR futures perspective, where they're pricing in the Fed path for the upcoming year. But the key here, and I want to demonstrate this by looking at a couple of past charts. So let's make one important distinction. There have been rallies in the 2-year bonds in the past that haven't led to stock market drops, but almost every stock market drop has had a rally in the 2 years before it happened. And so we want to just put into context that this doesn't guarantee it, but it is a warning sign that cannot be ignored. And so let's take an observation here, going a little bit back into the past, looking at the COVID crash. I circled in red with these little arrows the two breakout candle sequences on the 2-year note futures. And you can see that inevitably it led to a substantial rip higher in that 2-year note. And what I did here on the right-hand side is show the S&P 500 chart, with the red circles being those days that the bonds broke out. What you can observe is that when that 2-year note started to rip, it was actually corresponding with the market drop. Now, in the end, the acceleration and led by the 2-year going higher. I want to quickly show the same scenario going back here to Liberation Day just earlier this year. What you can observe is that there was a substantial downtrend in the 2-year note going out until February. Then we had the first breakout candle closing above the 50-day moving average back on February 21st. And then after a flagging formation that found support at its 50-day moving average, came a second breakout candle on the 28th of March. What you can observe here is that I circled on the right the S&P 500 and where it was at each one of those inflection points. Point being here is that the 2-year bond is a phenomenal tool for confirming whether or not stock market stress is underway and if it can escalate into something much bigger. So when we look here where we are today, we can observe that while we did see an initial start to a rally back in August, in fact, when that rally started, we saw a lot of those divergent signals, such as the breadth worsening, as well as some of the underpinning stocks actually starting to get hurt. But it was the sell-off here in September that actually triggered two new buy signals in treasury bonds, now ripping up to multi-month highs. You can observe here is that those two breakout candles on the 2-year corresponded with the markets trading up along their highs and these reversal candles. So the question now becomes, is this a warning sign of something bigger to come on the stock market? Well, look, there's a couple of key things to observe here. S&P 500 has yet to break down below the 50-day moving average, and we're not below the 6,600 level yet, but we are at a very important inflection point from a date perspective. Today is options expiration for the October monthly series, and when we go back to seasonality, we know that there was a huge amount of put hedging in the September and October months, trying to encompass what is the highly vulnerable period in the stock market. You want to think now that all of these hedges are rolled off, the market is now actually more vulnerable than it was before. And so we're in a situation where the market is hovering right at the 50-day moving average going into this option expiration. This is still a very important moment, because if we see that the S&P 500 breaks and sustainably closes below the 50-day moving average, this is actually an important trigger point. We've already seen vol targeting funds start to do some selling. There is over $100 billion of systematic trading strategies that will, without any discretion, start to sell when the triggers happen. And so the vol targeting funds, with the spike in volatility, have already started to degross. But CTAs, which are using a lot of quant and technical analysis techniques, really start to degross when we see sustained price action below the 50-day. And while they're not using necessarily the 50-day moving average as their signal, what I've found in the past is that any sustained price action below the 50-day is where you really see a lot of the this whatever the signals they're using all correspond with actually triggering some of that selling. In addition to that, you're going to have a whole series of dealer gamma that will eventually start to kick in from all of the short put positioning that they are forced to hold and hedge out through delta hedging. So the big question, are we going to get that close below the 50-day moving average? And will it be confirmed with a sustainable breakout of the 2-year Treasury note above this September high? These are things that I think are going to be very critical. Not only that, we're seeing stresses now in regional banks. And so with the regional bank breakdown, we talked about the importance of the banking sector. Well, we were focused earlier on the money center banks, the large ones like the JP Morgans of the world, but we're seeing the cracks now in the regionals. When I take a look at the XLF, what you can observe here is that the financial ETF initially, when these earnings came out, actually recovered. But now with the stresses, you can see the breakdown in the XLF financials ETF, which is critical because this is your quintessential beta 1 asset. And when we see that these financials go through any stress points, this is a warning. Not only that, but we also want to highlight the looking at where we're trading on the Mag 7 index. You can observe that there was a nasty breakdown day back on Friday, October 10th, and they have failed to meaningfully recover. And if we see these actually break to a lower low, look where that 50-day moving average is. This is where the leadership has been. The market breadth has been deteriorating for months. Here, look at the way that the price action has been behaving. We are now at a situation where 39% of stocks are trending. So that means 61% of stocks are in a downtrend. This breadth has been deteriorating consistently for 4 months. And the only thing that's held it up is that the mega cap stocks, those Mag 7s, have been holding this market higher just because of their huge market cap weighting. So if we see the financials and those Mag 7s break, with the 2-year bond ripping to the upside, this could get ugly. We have not seen the break yet, but consider yourselves warned. You should be hedging your portfolios and monitoring the situation closely. Now, does this have to turn into a nasty bear market? Does it have to turn into a bloodbath? Not necessarily, but there is going to be heightened volatility. Often these air pockets can be very fast and rapid. They may lead to an actual epic buying opportunity. I don't want to just fearmonger the idea that this has got to be just liquidate everything and panic. In the end, you have to look at it as an opportunity. The market here has been complacent for 5 months in a crawl higher, and things are starting to wake up. Let's see how this plays out.